Welcome to Stocks in Translation, our essential conversation cutting through the mayhem, the noisy numbers, and the hyperbole to bring you the information you need for your portfolio. And today I am joined by America's favorite producer, Sydnee Fried, along with Jeff Hirsch. He is the CEO of Hirsch Holdings. He is also the editor-in-chief of the Stock Trader's Almanac, publication his father launched this year, the year he was born. And this is going to reveal many insights about behavioral finance and market signals. If you've heard of the Santa Claus rally, this is where it all began, so stay tuned. I want to start with where we are in the markets, and it's been kind of a head scratcher for some people, but maybe you could introduce some of your work about seasonality and how that relates to how you see the market and what you're seeing right now.
Well, one of the things that Yale, my father, discovered was actually first really published in the 87 Almanac 86 was the best and worst 6-month switching strategy. A lot of people talk about sell in May and go away. That's a whole other story there. I've said, you got to buy in October to get your portfolio sober to sort of counteract that. But here we are in June, and we've had our seasonal MACD sell signal. We use MACD, which is a technical indicator to improve the entries and exits in and out of the best month. So basically, most of the market's gains have been made from November to April and pretty much sideways from May to October. And it's tracked pretty well the last several years. And we're also in an election year, so we've got this conversion of the 4-year cycle and the best and worst 6 months. And it's looking a little, extended from my vantage point. We also, we have our 5 disciplines. It's seasonality, of course, our roots, our foundation, fundamentals, technicals, monetary policy, and sentiment. So right now, sentiment's high, though that can stay high for a while. As a contraindicator that it tends to be used as, it's really only great when it's negative, when there's a lot of bears. Otherwise, it can stay. Through 21, sentiment was through the roof, and the market just ripped higher right through it. Technically, we're looking a little bit, struggling. Toppy, or at least extended. I don't see anything sinister coming in here.
Yeah.
Fundamentals.
It seems we've stalled a little bit.
Yeah, you see a conversion of all of the different technical fundamental indications with the seasonals, but it's still a very strong year. The best 6 months was up double the historic returns. We are tracking what we've put out there as a sitting president market pattern. And in this year, we've got 2 people that are known entities.
Yeah.
Politics aside, Wall Street is prepared to adjust with whoever they get in there, and we've dealt with both of these people before. So it's kind of reduced the uncertainty factor. So we see some chop right now. We're going to get some disappointments out of the Fed. We're going to have an economic reading that might be like
we're going to get into all of this. I can tell you had a burning question
I wanted to take a step back and talk about seasonality a little and how often some of these indicators and seasonalities actually come to pass. Like the January effect, how often is that true, right?
They do shift a little bit. A lot of them happen much more than people are willing to admit. There's a lot of skeptics about seasonality. The January effect gets confused with the January barometer. The January effect is a tendency for small caps to outperform large caps in January, whereas the January barometer is, as January goes, so goes the year. And that's one of the things.
So for the market overall. So one is very specific to small caps and others for the market overall. But have you back tested these things? I know of some back test theory, some backing that's been done, but how about you?
The best 6 months is the only proven black box system out there. There was a book in 2008, technical analysis book, evidence-based technical analysis, written by David Aronson, who's part of the CMT and Brew College, and they tested 6,000, I think it was 6,200 different black box systems against the scientific method, meaning disproving the null hypothesis, so that were the result of chance and had no predictive power. All of them failed. When we picked that book as our best book of the year back, and I think it was 08, if memory serves, we asked them to put the best 6 months. The binary, buy the last trading day of October, sell the last trading day of April, versus the other way around. And unlike any of the other 60,000 plus systems, this was the only one that had predictive power, and the results were not the result of chance. I mean, it's
really interesting that's what seasonality, kind of builds that alpha into the system. I've seen studies, I think this was done by IBD back in the way, but don't quote me, that seasonality accounts for up to 1/3 of the price action. So if you figure like the S&P 500, you can look at factors, you can look at different quant factors, but seasonality itself, which is where we are in the year, contributes up to 1/3 of the price action. But that also means that it doesn't work 2/3 of the time. So what does it mean to you? For instance, this year, I know April usually strong in May week. We had the reverse this year. So what do you do with that?
Well, we did some studies on that, and it's definitely a concern for us, but we've had so much strength coming in. We had that 5-month run, the negative April and positive May. And what we've seen is that the market tends to struggle. Like Q3 is a weak spot. So the down April, the best month for the Dow since 1950, just a general, known bullish month, it is a concern. And this is what plays into our outlook for some chop right here. You have the underlying sitting president, in the last 7 months of election years in general being bullish, only down two times in the last, 70 years since 1950. So down April has us cautious. The election cycle has us bullish. There's this, fundamental macro tech boom with AI that's pretty bullish.
Talk about that too.
We've got some technicals supporting us. NASDAQ, made a new high, finally broke through the 21, November 21 highs. That's looks like a nice support level. There's a lot of, the economy is resilient. The jobs, number came out, was pretty strong. I know that upset everyone that's looking for the cuts. We were never in that 6-7 cuts camp. So
just let me ask you, let's cut through, because sometimes when we talk statistics, all this seasonality, not everybody understands it. Statistics can get a bad rap. How do you make sure you're not overusing this seasonality,
like overfitting
this, and kind of make sure your results are relevant to what is happening?
I think if you keep it, I know when you try to do it on too short of a time frame, that's when you get messed up. So
no day traders should employ these methods.
They be careful with it. Don't expect it just because it says in the Almanac that this day is up, 85% of the time. Does it, look at some other factors, technicals, fundamentals, before you make that trade just based on seasonality alone. But, over the long haul, when we do a lot of sector swing setups for, stock sectors and even commodity related sectors, a lot of it with ETFs, you're looking for the underlying stock or market or sector ETF to be tracking the seasonal pattern before you getting into it. So you want to see
you want to see a little bit of
you want to see it actually fitting,
Okay.
And then you're looking for a technical setup or some other underlying reason. There might be something in the news, whether, it might be gold short season, but everyone's buying gold, it's up. So you're not going to go shorting gold or going bearish on gold. And with the whole market, it is tracking the 4-year cycle so closely. It makes me a little nervous. It's going to end at some point.
Yeah, but it always ends.
It always
starts over. Cyclicals, cycles, it's the theme of the show.
So, you got to make sure it's tracking closely to the seasonal pattern. I think that's the key. And be careful with the real short time frame seasonal.
Well, I neglected to mention in the open that this episode is brought to you by the number 1.5. That is the number of Federal Reserve cuts the market is pricing in by December. We're going to talk about that in a minute. I want to get to our word of the day, which is seasonality. And first, let's start with the definition. This is according to Investopedia. Seasonality is a characteristic of a time series, which could be stock prices, in which the data experiences regular and predictable changes that recur every calendar year. Any predictable fluctuation or pattern that recurs or repeats over a 1-year period is said to be seasonal. And I should add that this is a different concept than cyclicality. And I am personally guilty of conflating the two. I will say seasonals when it's really cyclical, but I'm just wondering, what does seasonality mean to you, Jeff?
Means everything.
Yeah, all right. It's your paycheck.
It means my livelihood, my business. To me, it's just, really understanding what makes the market and the world tick, what makes people tick. You can see these behaviors. I'll give you a little example. Here's a little story. from when I first started working for my father full time. When I said, you know what, all right, I'll come work with you. I want a business card and a title and a salary, whatever. But we were sitting around the table, conference. We had some other writers and analysts there, and we were looking at the monthly cash flows, where you see this. It used to be the last day of the month and the first four of the new month were the monthly 5-day bulge, where all the markets gains.
So portfolio rebalancing, kind of getting
cash flows in and out of the market, and we saw this mid-month spike because this is one of the things I used to run by hand. I used to underline the daily moves in Barron's with a red pen and a little short ruler that I still have, and then add it up on an adding machine.
Love it.
With graph paper back in the 80s and 90s. No, just a pencil, and my father had a proprietary way of examining the monthly trading days. So we see this mid-month spike. What's going on here? And we had the understanding that that's the payroll deductions going into the mutual funds, and mutual funds are long only pretty much. They got to put it into the market. So it's the either bi-monthly or every 2-week payroll deduction being injected into the market, creating this change in seasonality. So that's why I love it, that you can see what makes the market tick. I mean, they talk about the algos and all the high frequency trading,
minute by minute, second by second.
Yeah, but they're programmed by humans. There's biases in there. I know it's not. It's great. It's faster and awesome, but it's still. And the thing that if you look at the book, I know you're familiar with it. There's the intraday trading patterns at the back of the book, which was the half-hourly moves. And to me, I find it amazing that despite all this HFT and algo trading, those patterns still tend to work. Where you see that lull around 2:30, the rally to the close.
People still got to go to lunch. Apparently.
People still gonna need their coffee at just after lunch at 2:00, which is low. So that's what I love about it, that you can sort of see how the world, what makes it tick.
Yeah, we got to take a quick break here. I mentioned briefly before this episode brought to you by the number 1.5. Why 1.5? That is the number of Fed rate cuts of 25 basis points apiece that are priced into the market through December of this year. They got a mid-month December meeting, and they have one this week. So that's why we're talking about this. Gives us an opportunity. We touched on the Fed a little bit before, but as you noted, we're a long way from the 6 at the start of the year. Do you think the rate cut discussion matters at all at this point?
Less than it did. It matters, but the economy has surely proven that it can handle it. Are you getting the 1.5 from? Is that the CME futures?
It's the WIRP screen, but yeah, it's based on either Fed swaps or CME futures. I think they're both saying about the same thing.
Yeah, I mean, I just put in my subscriber monthly webinar the updated, CME futures for the next 2 meetings. We've been, not on we're going to get a lot of cuts this year, and I think the markets realize it's not going to get more than 2. I said it on another, interview that so we're definitely getting 2 this year. I said, maybe 2, definitely 1, probably 1, but maybe 2. So that 1.5 agrees with me. I agree with it. I don't think it matters as much. I think we got to look at GDP. We want to make sure that whatever little slowdown there doesn't get too slow. It's understandable after the banner, growth we had coming out of COVID and even in the fourth quarter last year, that there's going to be a little softness there. So,
well, Jeff, you had a really interesting call on recessions. You specifically said we already had one in the first half of 2022, and that was when we had back-to-back quarters of negative GDP growth. But I'm learning that is not maybe the official definition.
It used to be.
It used to be unofficial.
Germany still uses it. Other countries still use it. Other big industrial nations, I think that they changed it to make it easy.
I've heard from a couple of people in the last week just kind of saying, the soft landing, it's already in the rearview mirror. This would seem to be in the same camp. So what's important to me about this call is, what does it mean going forward?
I mean, going forward, it means that, this whole inverted yield curve. And
it's already done?
It's done. It happened. It's not an issue. What we're looking at is where the next break is going to come. And, I'm going to rely on some of my cycles, maybe some of the, more perennial cycles like the 4-year cycle, which we're getting into a post-election year next year. I don't foresee a recession on the horizon but it doesn't mean it's not possible. I think post-election year, midterm years, where you'll see those things. I mean, we had our recession in 22 and our textbook midterm year bear market bottom in October, which, has been the bear killer for since my father named it that in '69. But the economy's looking very well. There's a lot of money coming in from the government. I don't see a recession on the horizon. It's not to say we won't get one in a couple of years or so.
Is there a seasonality to recessions?
You don't get one every year, so I don't know.
I mean, by the definition, first of all, I love Investopedia, and by the definition there, there's a yearly no.
But does it happen to occur regularly in a predictable fashion?
I haven't seen it.
Yeah, I haven't seen it.
People try, and this whole yield curve predicting the recession thing kind of throws that whole capacity to predict a recession out the window, and usually it's caused by some sort of event or something that changes, whether it's COVID or a war or something going on in the market systemically or the economy systemically. So I don't see a cyclical or cycle.
One day we'll go over chondritive cycles, and your head will just explode.
I don't want to know. I don't want to know what that is.
There are cycles that are based. There's stock market predictions based on the lunar cycles, the zodiac, everything.
Oh,
so there's something.
I do want to know what that is.
There's something for everybody. I don't think you get into the zodiac in your work.
No, when I'm, out at some festival, I might, think about what your sign is. But other than that,
based on horoscope, I have one quick question. So we've been talking a bit about being in an election year. What should we expect as we get a little closer in terms of equities for people to start seeing, and what's the seasonality there?
Yes.
There's a chart I put out recently that shows that the NASDAQ highlights this sort of little sideways action June, July ahead of the conventions. So we can just a bit of chop and sideways action. Once we get through the conventions and it's really decided who's in the general election, then the market tends to begin to rally, especially after the election. If we can get,
that's where the juice is last time. Anyway.
If we can get an actual decision on election day or the next day, unlike 2000 and the other recent history, the market will be very pleased that we have decided.
Just the fact that there is a decision.
Correct.
That's funny.
So the last 7 months, as I alluded to before of election years, only 2 losses. So it's kind of 45-degree angle on the chart going up. I mean, it's after this little soft period, seasonal soft period. I think we're
all right,
pretty bullish.
All right, so I got to say, it's time to roll out the red carpet here, and it's time for Who Wore It Better. Today, we are pitting seasonality maps against each other. Perfect for you, Jeff. You're going to see this done nowhere else in media because it is just too powerful. So we've been talking about the various ways to slice and dice the current trading year. It is the 4th year of the presidential cycle, an election year. It's also an election year with a Democrat incumbent. And it's also a year marked by a strong first quarter, a down April, and an up May. And Jeff, you're the only person we could ask this to, besides maybe Ryan Dietrich, is what is the seasonality map that is worn by 2024 the best?
I think the sitting president running for re-election, whatever party, is what's happening here. What we just had with the down April and up May that you're talking about shows a little more chop and weakness. So the combination of those two is the map that I'm looking at that seems to be tracking closest right now for 2024.
And we got some more time here. I'd be really interested to hear about when you were a kid, how you were. The Stock Trader's Almanac is as old as you are. So from day one, you were just kind of immersed in it. You're talking about doing calculations by hand, which I love. Just what was that like?
I mean, born, bred, weaned, raised on cycles, seasonalities, and patterns. I used to go in and say goodnight to Pop while looking over charts, when he was working from the home office back then. It was... the business was in the house. It wasn't just all cycles and patterns and seasonalities and stuff. It was, Hirsch organization, can I help you? Taking an order at the kitchen table. There was a 5-button phone everywhere. Wow. I used to go down there, like Monday Night Football was the night I would go downstairs with a little TV and ship all the books out to the brokers. I mean, we sent books to Hong Kong and Switzerland and London and, Peoria and everywhere to every broker that, they would buy 6
Based
of them.
on the Monday Night Football results.
It
Or
was
is that just
it was just
coincident?
my time to
Okay.
get it
gotcha.
out. You know, it was like something. It was I had something to do while I was packing, putting the invoices in there. But there was always a discussion. I mean, it was Wall Street week for dinner on Friday nights.
Louis
and-
Ruckhiser?
Yeah, I mean, Dad was on there a couple times back in the late '70s, early '80s. So
Shout out to Wall Street Week, because that is a show. I didn't get into finance until about 2005. Unfortunately, that was the year of Ruckhiser's death. But it was an amazing show that was put on by PBS, and you'd have these various Wall Street hedge fund guys just kind of casually talk about the market in a PBS type setting. Tell us about your father's appearance.
it had come about when I made this prediction for Dow 38,820, the super boom, which I put out in May 2010, and it was built off of Yale's another long cycle that he discovered of how the market rallies with after inflation and war. And he had a prediction in '76 for Dow 3420 by 1990, and that was that and some of the other cycles, other patterns.
I'll get some headlines.
That'll get some headlines. I remember he had I still have some of the old T-shirts that say Dow 3420, and I think Ruckhiser, if I remember, spoke at that conference. He was like the keynote that my father ran up in. It was what was the Tarrytown Hilton. Now it's a DoubleTree or something. But yeah, that was why he was on there. I've got a picture in my office of him. I think Mom was
Sounds like
down
I
there.
got the name wrong. Ruckhiser is the correct pronunciation.
Did I say it different?
No, I
Jared.
I said Ruckhiser.
Ruckhiser.
But again, I was not aware of the show until after it had ended. But Sid, you got something here before we go.
I want to know, my question is twofold. The first stock market concept you ever learned, whatever that means to you, and then the concept that took you the longest to understand or nail.
Oh boy. The first one that I really understood was probably the intraday, the cash flows, the calculations I did for my father, the monthly, 5-day bulge. That was what really clicked. I understood what happened there. And what eludes me right now, oh God, probably derivatives. I'm not an options trader, I don't see that stuff. Calculus and algebra is not my thing. I'm a little more verbal than that, I think. But it's probably the trading of options and futures.
We got a minute. Anything else you want to share with the viewers?
I can tell you that we are tracking very closely to the seasonal and 4-year cycle patterns. It calls for.
And this calls forward. What can we expect?
Can expect more new highs at the end of the year. A little sideways action here, but I'm writing my outlook for next year already. We're working on 25. I should be done with that this week. I'm getting concerned about 2025.
Interesting. Being
a post-election year. After we've been through so much, and just the cycle of work that I do, and the fact that we're due for a break from how far the market's gone over the last several years.
Yeah, it seems like we've been nothing but double-digit returns for quite some time, except for 2022.
I was going to say, how does tech come into what you're projecting for 2025? Like, is the AI boom, what does that kind of do for your predictions?
I think it's gotten a bit ahead of itself. As some of these, and I don't think it's a bubble. I think it's
Not
real.
yet.
I'm
just wondering, not yet?
No, I don't think it's. I think it's not. Maybe not ever. It may be a little ahead of itself, but there's some real depth to this industry, this technology. It's finding itself into everything.
We're winding things down here at Stocks in Translation, but here's a poem of our own before you go. May your powder be dry and your account balance be high. That's all for now. Stick with Yahoo Finance.